AI spending, higher real yields, and fresh energy shocks are pulling portfolios in different directions, creating a single theme that now links equities, credit, and even sovereign risk. Welcome to vTalkInsight, Allocator's Lens Daily for July 8th, 2026. In equities, the central tension is between powerful earnings support and increasingly concentrated risks around the AI theme. U.S. corporate profit growth projection for the second quarter have been revised sharply higher, from about 14% at the start of the year to over 23% now, with large tech platforms expected to deliver roughly 3/4 of that expansion. At the same time, market breadth has improved meaningfully, with around half of S&P 500 members up more than 10% year-to-date, and small caps, industrials, healthcare, and even energy participating more fully in the tape. Beneath that healthier breadth sits a highly unusual semiconductor cycle, driven by AI infrastructure rather than a typical inventory rebuild. Memory demand tied to data centers and AI inference appears structurally strong, and constrained capacity, especially outside China, is supporting prices and margins for now. But chip stocks have rallied roughly 50% in a month. Samsung delivered 19-fold profit surge only to see its share price fall more than 10%, and European chip names are selling off despite strong fundamentals, all of which points to valuation fatigue and bubble anxiety. Volatility is also shifting under the surface. Single stock and tech sector option volatility are near their widest gap versus the equity risk premium since the dot-com era, while index-level volatility gauges remain subdued. Momentum baskets have suffered drawdowns of more than 20%. Hedge fund positioning is the most bearish since before the global financial crisis, and yet diversification has outperformed concentrated mega-cap exposure as leadership broadens to small caps, equal-weighted indices, and select emerging markets such as Japan and Korea. For allocators, that means AI-driven capex is still a powerful support for earnings and deal activity, but it now represents a single factor cutting across equities, venture capital, and even corporate balance sheets. So watching for any sign of demand disappointment or policy shock in this theme is critical before thinking about the next move in other assets. Turning to rates, the policy backdrop is dominated by a Federal Reserve that looks inclined to sit tight for the rest of the year. Inflation pressures have eased compared with late last year, helped by earlier declines in energy, and a labor market remains resilient even after some cooling, which together argue for a wait-and-see stance rather than fresh hikes or cuts. At the same time, geopolitical shocks have pushed headline inflation back up toward roughly 4%. So the bar for rapid easing stays high even as markets debate when the next cutting cycle might begin. Real yields have risen as inflation expectations fall, suggesting investors are starting to price in a higher neutral rate and more persistent disinflation. Some see the most interesting value in the 5 to 10-year segment, including inflation-linked bonds, but that sits against a powerful technical headwind from heavy issuance of both treasuries and long-dated investment-grade corporate paper, including large multi-tranche deals for major tech names. That supply is acting as a floor under nominal yields, with some desks now talking about the risk of U.S. 10-year yields drifting toward 5% if debt competition for capital continues to intensify. Globally, the picture is equally nuanced. Demand for very long-dated Japanese government bonds has picked up at yields near 4%, while French spreads over Germany have widened back to their recent peaks, driven much more by political uncertainty than by any deterioration in budget forecasts or commodity prices. In the UK, potential changes to bank leverage ratio rules and new limits on hedge fund activity could bolster demand for gilts, but also increase volatility if market-making capacity is reduced. Overlay that with central banks stepping back from rigid forward guidance, and it is clear why volatility is migrating from equities to rates. Auction results, political milestones, and incoming inflation data are likely to be the key catalyst to watch for the next leg in global curves. In credit, the surface remains calm, but the composition of risk is changing quickly. Large investment-grade issuers, especially U.S. tech hyperscalers, are tapping bond markets aggressively to finance multi-year AI and data center build-outs. Amazon's recent plan to raise around $25 billion in fixed-rate debt is emblematic of that trend. Despite the supply, demand for high-quality paper remains strong, with mid to low-duration investment grade offering yields in the 5 to 6% range and spreads that have absorbed the issuance without a major repricing so far. Below the surface, stress is building at the weaker end of the spectrum. Triple C-rated spreads are widening. Leveraged bank loan borrowers face tougher refinancing conditions, and at least one major bank has suspended new lending to riskier private credit funds after a string of bankruptcies. Private credit defaults have ticked higher, although from very low levels, and dispersion across managers is increasing as earlier, more aggressive vintages struggle while new capital flows chase AI and infrastructure-linked deals with better lender protections. The broader issue for allocators is that AI-related investment is becoming a single factor in credit just as it is in equities. Corporate bond issuance from a handful of cash-rich technology platforms is crowding out some demand for treasuries and potentially for non-AI sectors, while resource displacement means spreads for companies outside the digital infrastructure theme may have to widen to compete for capital. For now, fundamentals for high-quality AI and infrastructure borrowers remain solid and rating agencies see little downgrade risk. But if earnings do not materialize within a few years, sentiment could shift quickly. So monitoring default trends, new issue concessions, and sector-level spread moves will be important. Foreign exchange markets sit at the intersection of these themes. Despite frequent headlines about de-dollarization, the U.S. dollar still looks structurally strong, with deep liquidity and robust use in global transactions, helped by the relative resilience of the U.S. economy and still elevated real yields. That said, if the Fed continues to pause while other central banks slowly converge on similar policy stances, the cyclical support for the dollar could fade in the second half, especially if growth leadership rotates toward regions with cheaper equity valuations. Emerging markets add another layer. Several markets that are less tied to the AI hardware trade, including parts of Latin America and some Asian exporters, are flagged as offering relatively attractive equity valuations and strong year-to-date performance, which over time can feed back into currency demand. At the same time, higher energy prices, driven by shipping risks around key choke points, keep pressure on the external balances of major importers, while the shift of volatility toward rates means policy surprises can propagate quickly through FX. For allocators, the key questions are how long dollar strength coexists with improving non-U.S. growth and when rate differentials begin to move decisively against the greenback. Commodities, and energy in particular, are once again a focal point for macro risk. Recent attacks on vessels near the Strait of Hormuz, including a Qatari LNG carrier reportedly hit by an Iranian missile, have pushed both oil and gas prices higher and forced tankers to reroute, raising shipping times and insurance costs. European natural gas prices remain roughly 70% above pre-war levels, underlining just how constrained global LNG infrastructure still is compared with oil, where benchmark crude has largely retraced to pre-conflict ranges. The oil market itself is sending mixed signals. Geopolitics and shipping risks are supporting spot prices, yet Saudi price cuts into Asia and evidence of a front-end supply glut point to near-term oversupply that could keep volatility elevated. Chinese buying behavior is a key swing factor, with scenarios being discussed that range from Brent closer to $60 if restocking pauses to near $80 if demand reaccelerates. Energy equities are already reflecting some of this, with majors like Shell reporting strong trading driven by volatility, and the energy sector recently standing out as one of the few groups in positive territory on weak index days. These commodity dynamics loop back into both inflation and the AI story. Higher oil and gas prices have contributed to the move in headline inflation from roughly 2.5% to just over 4% this year, reinforcing the case for central bank caution even as core measures moderate. At the same time, the AI infrastructure build-out is highly energy-intensive, spurring investment not only in gas and renewables, but also in areas like nuclear fuel conversion and data center cooling, which ties commodity markets ever more tightly to the performance of a single growth theme. For multi-asset portfolios, that means energy prices now influence not just inflation and rates, but also the cost base and competitiveness of the very companies driving equity and credit leadership. Stepping back, today's cross-asset picture shows a market still underpinned by strong earnings and a powerful AI-driven investment cycle, but with rising tension between that growth story and the realities of higher real yields, heavy debt issuance, and renewed energy shocks. Equities are transitioning from a narrow, mega-cap tech-led rally toward broader participation across small caps, cyclicals, and select emerging markets, even as valuations and volatility in semiconductors flash late-cycle signals. Rates are anchored by a Federal Reserve that appears comfortable on hold, yet term premia and political risk in places like France keep curve dynamics fluid, while credit markets continue to fund the AI build-out with tight investment-grade spreads, but growing stress in weaker and private segments. In FX, a structurally strong dollar faces a gradually less supportive cyclical backdrop, and in commodities, shipping risks and LNG constraints are reasserting energy as a key driver of both inflation and earnings. For allocators, the common thread is concentration. AI now links equity leadership, corporate funding, sovereign dynamics, and even commodity demand, so tracking that single factor across assets, alongside inflation data and policy shifts, will be critical in the weeks ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.